Would we invest in Deutsche Bank bonds personally? Hello, members, super savers, and Bond Course fans. I hope you're healthy and well. As many of our Diamond NestEgg regulars know, I often post new issue agency and corporate bond offerings in our member zone that I think some of our members might find interesting. And I've shared some of the most attractive opportunities with everyone in our community in these recent agency and corporate bond videos. And Deutsche Bank is a name that many of us have seen in recent months on the list of the highest yielding new issue corporate bond offerings on Fidelity. In fact, it tops that list again in the first full trading week of the year with this callable 6.05% coupon bond that matures in 2045 with a first call date in January 2026, about 2 years from now. No wonder then that so many of you have asked us questions about Deutsche Bank recently. So with that in mind, here are the 3 topics that we'll be covering in today's video. 1. What are the 3 key risks to consider before investing in Deutsche Bank bonds? 2. What other important risks should you take into account when investing in corporate bonds at the moment? And 3. Would we invest in Deutsche Bank bonds personally? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What are the 3 key risks to consider before investing in Deutsche Bank bonds? All the Deutsche Bank bonds that we've shown you so far on this channel are denominated in US dollars, have a CUSIP, and are registered with the SEC. For all practical purposes, this means that you have no currency risk and that taxation will follow the same rules as for any other domestic bond as long as you hold it in a domestic account. If in doubt, please call your broker or speak to your tax advisor to confirm. That said, there are 3 Deutsche Bank specific risks to consider as a bond investor. The first is Germany country risk. You will be exposed to this to some degree, as Deutsche Bank is headquartered in Frankfurt, Germany. And Germany has been in the news a lot recently with some less than flattering headlines because it hasn't really been growing since the double whammy of COVID and the Ukraine war hit it much harder than the US. And this lack of growth applies to most of Europe, by the way, not just Germany. So, the International Monetary Fund, in its latest report from October 2024, expects German real GDP to not grow at all in 2024, and at a paltry 0.8% in 2025. In contrast, expectations for the U.S. are 2.8% real GDP growth for 2024, and a still respectable 2.2% for 2025. So Germany definitely has a growth problem, which should always give prospective investors pause for thought before making an informed decision. That said, we're not talking about equity investments here, where one of the key investment metrics is growth. We're talking about bond investments, where one of the key metrics, in fact, some may even argue the key metric, is the ability to pay back your debt on time and in full to your bondholders. And from this perspective, Germany does have a few strengths. For starters, and maybe surprising to some, Germany's sovereign credit rating is a clean AAA across S&P, Moody's, and Fitch, while the U.S. holds this top rating only with Moody's. S&P and Fitch have both downgraded the U.S. by 1 notch to AA+ in the recent past, as we've discussed on this channel. There are, in essence, 2 main reasons why the 3 large ratings agencies are signaling that they are not concerned about Germany's ability as a country to repay its debts when they fall due. First, Germany runs a large positive current account balance of 6.6% of GDP, meaning that's how much more Germany exports than it imports, earning them dollars and other foreign currencies. And second, Germany's national debt stands at 45.6% of GDP, less than half the 98.8% for the US. Now, let's say that you can get comfortable with the country risk for Germany. This brings us then to the second key Deutsche Bank specific risk as a bond investor. You will be exposed to the credit risk of Deutsche Bank, meaning their ability as a firm to pay back their debt on time and in full to their bondholders. As some of you may remember, Deutsche Bank did go through a few rough years not too long ago, but they seem to have turned the corner and showed a net profit of 1.665 billion euros, roughly $1.7 billion in their last quarterly report for Q3 2024. Now, this may not be enough for Deutsche Bank to keep up with the profitability of their leading U.S. competitors, and may not be enough to recommend buying Deutsche Bank stock either. But again, we are not talking about an equity investment into Deutsche Bank here. We're talking about a fixed income investment into Deutsche Bank. For the big three ratings agencies, Deutsche Bank's profits seem to be sufficient to service any outstanding bonds for the foreseeable future. At the time of this taping, they all show investment-grade long-term issuer ratings for Deutsche Bank. S&P gives an A, Moody's gives an A1, and Fitch gives an A-. And for comparison, that's not too different from where JP Morgan Chase currently stands, with an A from S&P, A1 from Moody's, and AA- from Fitch. Although I should add for completeness sake that JP Morgan Chase is overall slightly ahead. Not only does it have a slightly better long-term issuer rating from Fitch than Deutsche Bank, it also has a positive outlook from S&P versus a merely stable outlook for Deutsche Bank. Let's move on now to the third key Deutsche Bank specific risk as a bond investor, convertibility risk. When you look up Deutsche Bank's bonds on Fidelity, as we tend to do on this channel, they are marked as convertible, meaning they have a feature in their conditions that may allow Deutsche Bank, under certain circumstances, to redeem the bonds not in cash, but in other instruments, such as equity. So this convertibility feature is not something that Deutsche Bank put in of their own volition, but it is a German and European regulatory requirement that was introduced after the great financial crisis of 2008-2009, and that would allow the regulator to convert these bonds into, let's say, equity if that was needed to save the bank. This would most likely become relevant only under a severe stress scenario for Deutsche Bank and not under more normal economic circumstances. But it is still a feature you need to consider before you buy the bonds. That said, Deutsche Bank is a GSIB, a global systemically important bank. If you're newer to GSIBs, I've linked our most recent video on global systemically important banks in the first pinned comment below for reference, where I go through why we feel that GSIBs generally enjoy a bit of special government backing. So, German country risk, the credit risk of Deutsche Bank as a firm, and convertibility risk. Those are the three key Deutsche Bank specific risks to consider as a bond investor, which is a great segue into the next section of today's video. What other important risks should you take into account when investing in corporate bonds at the moment? If we go back to the 6.05% new issue offering from Deutsche Bank, the first call date is January 2026, about 2 years from now. It's a nice coupon, and if this bond never gets called and you hold it to maturity, you would get the 6.05% coupon for the next 20 years. That's the best case scenario. In the worst case scenario, though, assuming a no default situation, if this bond is called on the first call date in January 2026, you would only get the 6.05% coupon for 2 years. And if interest rates go down between now and then, you won't be able to find a similarly attractive coupon. This is known as reinvestment risk. The risk that you may not be able to find another comparable investment that pays a similar or higher rate when you cash out of your existing bond, either because it gets called by the issuer, it matures, or it's sold by you. And unfortunately, most of the non-treasury new issue offerings at the moment, like this Deutsche Bank bond, are callable, meaning they will expose you to reinvestment risk. So do take that into consideration as well. Of course, this is also generally the reason why an investor in callable bonds gets a bit of an extra yield premium for accepting the possible reinvestment risk that may occur if and or when the bond is called. As I always say, only buy callable bonds if you're okay with them being either called early or not called at all. Bond beginners, folks, if you need a refresher on anything that we've covered today, please refer back to Module 2 on the risks of bond investing, where we dive deeper into these risks that we just talked about, as well as interest rate risk, inflation risk, and liquidity risk, and how they apply to corporates, as well as treasuries, agencies, and munis. With that in mind, let's move on now to the next section of today's video. Would we invest in Deutsche Bank bonds personally? And the answer to this question is yes. We would invest in this Deutsche Bank bond as part of an overall diversified fixed income portfolio if we were close to retirement or already in retirement. As some of our Diamond NestEgg regulars know, Marcus is Austrian, and we lived in Germany for many years before moving back to the US. We were actually just in Frankfurt this past Christmas to visit family and friends. So we know the country and the financial and regulatory environment well. Plus, Deutsche Bank is our go-to bank whenever we go back to visit, meaning that we are comfortable with the German country risk, the credit risk of Deutsche Bank, and the convertibility risk. And we would take this coupon for as long as it's available to us, either until the date that it gets called, or even better, when it matures. But that's us in a hypothetical close to retirement or already in retirement scenario. And as I always say, everyone's financial journey is different. What about you? How comfortable are you with these risks? Or would you prefer to invest in a domestic bank or just stick to treasuries? Drop a comment below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new about Germany and Deutsche Bank bonds. And if you want to kick off the year with a bang and learn all about bond investing, then check out this video here on our beginner and intermediate bond courses, which we are in the process of updating for 2025. Or come join our next live sessions this month. Our next Bond Beginners Live will be on Sunday, January 19th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 20-year T-bond and 10-year TIPS auctions. And our next YouTube Member Live will be on Sunday, January 26th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.